Hello everyone, and welcome back to the Quant Lab. In our previous lectures, we studied specialized mechanical algorithms designed to trigger strict, isolated actions, like the DeMark exhaustion count and the parabolic SAR trailing stop. Today, we turn our attention to composite trend systems. A standard single moving average is highly vulnerable to random market noise and false breakouts. To solve this, quantitative traders do not rely on one line. They calculate a dense matrix of multiple moving averages simultaneously. By observing how these averages compress, expand, and overlap, we can visually map the exact moment short-term retail momentum aligns with long-term institutional capital. Our first system is the Guppy Multiple Moving Average, or GMMA. Developed by Dale Guppy, this system plots 12 distinct exponential moving averages, separated into two behavioral clusters. The first cluster uses short look-back periods, 3, 5, 8, 10, 12, and 15 days. This ribbon represents the immediate cost basis of retail and short-term speculative capital. The slow cluster uses extended periods 30, 35, 40, 45, 50, and 60 days. This ribbon represents the heavy baseline capital of long-term institutional investors. We do not look at individual lines. We analyze the geometry of the clusters. When the EMAs within a cluster tightly squeeze together, we have volatility compression. The market has reached a state of equilibrium and the violent breakout is imminent. When the EMAs spread far apart, we have trend expansion, confirming massive subtennial momentum. Also, we have the golden cross and death cross in GMMA as well. When the entire compressed fast cluster aggressively crosses upward through the slow cluster, we call it a golden cross. And this triggers a massive systemic long entry. On the other hand, if the fast cluster breaks downward through the slow cluster, then that is a death cross, which is a definitive exit and short sell signal. Let's look at one example. So let's look at the 2025 daily chart for Tesla. And to use this indicator, we just need to search GMMA from your indicator and then you just click it. And then you can see this two clusters. The first cluster is in blue, and the slow cluster is in orange. And you can see the setting. If you click that, then you can see that, okay, we have EMA 35, etc. for short, for fast clusters, and for slow cluster, we have 30 up to 60. Right. So this perfectly illustrates the structural lifestyle cycle of a trend. Notice the defensive macro desk cross on February 13th. So right here, where the entire blue fast cluster slides downward through the orange slow cluster. And this triggers a severe downtrend from here to here. But look at the late April through mid-May. The orange slow cluster undergoes extreme volatility compression. So it comes together. The lines are completely squeezed together. This tells us or algorithms that institutions are accumulating in a tight range. Then on May 13th, here, the blue cluster surges upward through the orange cluster, and that is triggering a macro golden cross. The most powerful phase of this system is visible from early September to early November. So after the golden cross right here. Okay, and we can see this uptrend. Both the fast and slow clusters exhibit massive trend expansion. So you can see the orange spread out and also blue spread out. They fan out perfectly, visually confirming a highly sustainable, explosive momentum shift. So again, after this dead cross, a downtrend happened. And after this golden cross here and here, we have upper trends from here to here, here to here. And it works pretty good. And let's get back to the lecture, and I have a screenshot the examples right here and add some explanations for this example. Okay, well, the GMMA uses 12 lines to visualize expansion. Our next tool mathematically compresses an entire multi-timeframe matrix into a single line, the BBI, or bull and bear index. By averaging the 3, 6, 12, and 24-day simple moving averages, the BBI generates one definitive median trajectory. It smooths out high-frequency noise without suffering the lag of a standard 50-day moving average. However, there is a strict liquidity prerequisite. Because this math relies on the continuous flow of capital across 24 days, it is strictly optimized for mid to large cap liquidity. In the Quant Lab, we only apply the BBI to companies with a market capitalization exceeding $10 billion. It will fail on low float macro cap because their erratic, manipulated price specs shatter the mathematical logic. And some comments before we see the example. First, the BBI acts as the absolute dividing line, which means that when the stock price is above BBI, the market is in a consolidation or upward trend. And when the stock is below the BBI, it is in a downward trend. And second one is the BBI can be act as the support line if it is in an upward trend, and it is an resistance line that if it is in a downward trend. And third one is for the buying signal and selling signal. When the K line breaks from below to above the BBI, then we say it is a bear to blue reversal, which is a buy signal. And when the stock price, falling below the BBI, then we say it is a bull to bear reversal, or it is a sell signal. But I also recommend that we not only use this BBI to trade. It works better when we combine it with K-line technical patterns, especially top and bottom reversal from formation testing this BBI line. And let's look at one example. All right, so let's look at NVIDIA from April to July 2026. The BBI acts as our absolute dividing line. So how to how to see this BBI? You just need to search BBI again from the indicator, and then you click it. Okay. And you can see this curve or line right here. All right, so let's look at April. When the stock closing price across this BBI line from below to above, it is a buy signal. And during the strong uptrend in this April and early May, the stock stays safely above the BBI. When the price pulls back, it uses that orange BBI as premier dynamic support to buy the dip. However, in late May, the price definitively breaks below the indicator. A regime shift has occurred. Throughout June and July, the market enters a choppy downtrend. The BBI flips its mathematical function. It now acts as a suffocating resistance ceiling right here, continuously rejecting upward rebounds. Remember our golden rule, the BBI must never be traded blindly. You wait for the price to touch the BBI and you look for candlestick reversal patterns to pull the trigger. In other words, if you want to use this BBI solely, then it works perfectly for uptrend. But for consolidation scenario or downtrend, it didn't work pretty good. Again, the example I have a screenshot and put it here. And finally, because the BBI is so mathematically robust, institutional models frequently use it to upgrade other systems. And let's see exact same NVIDIA chart, but we have applied the BBI-BOLL indicator instead of using a standard 20-period moving averages at the center of the Bollinger Bands. We replace the core with the multi-timeframe BBI line. And let's look at this example. Okay, so search from indicator and you can see this BBI-BOLL, which combines BBI with this Bollinger. Okay, so right, standard Bollinger principles apply beautifully here. During the April-May uptrend, we see aggressive volatility expansion from here, right here. with the price reading the upper yellow band, we're using the BBI center line as mean reversion support. When the regime fractures in June, the bands contract. The price then repeatedly bounces off the low blue band as dynamic support here. But it continually rejected by the BBI center line, which was acting as a strict mean reversion resistance. Mastering these composite systems allows you to trade alongside institutional capital flows. See you in the next lecture.